And it's time now for the Wall Street Beat. Today we are looking at the much anticipated debut of the private debt ETF from Apollo and State Street. It is the first one to reach the market, and it will test the limits of investor appetite for one of the hottest areas of finance. It's set to trade under the ticker PRIV. Joining us now, Eric Balchunas, Bloomberg Intelligence Senior ETF Analyst. You know, it's hard, Katie has been pointing out to me earlier, it's going to be hard to figure out the reaction from early trades, really. But this has the potential to change two industries pretty drastically. Apollo started a trading desk in order to make markets in private investment grade debt to help facilitate making this market more liquid. But do you still see any concerns around liquidity if things go bad?
Yeah, that's a big concern, right? There's the fund, as you said, it's really a trailblazing fund because prior to this you could only have up to 15% in illiquid securities. With this, you can go up to 35 and even more. There's some fine print in there. So this is going further than any ETF has gone, and they solved that by using Apollo, and the SEC was okay with that. But yeah, if there's an illiquidity issue, right? I will say, I think this ETF should be considered a hybrid. It's like mostly ETF, but maybe a little closed-end fund. But here's the thing. We've seen this happen before. EM had a problem with the Russia stocks that it owned. They got illiquid. The EM ETFs traded on. Their arbitrage band stretches a little bit, but they still trade. And my opinion is ETF investors have been accustomed now for years to occasionally having stuff that goes illiquid inside the portfolio. The ETF trades on, and they understand that the percent premium discount will stretch a little bit. Right. So I think the market's going to be comfortable with this. The question is, will they want it? You know, private credit versus private equity. How much will it return? I think those things matter too.
Yeah, absolutely. And I mean, you make a great point that we've been in similar situations, and some of the illiquidity doom loop sort of warnings I'm seeing kind of remind me of what we have seen in traditional fixed income as well. But obviously, like you said, this is trailblazing, so we'll just have to see. I want to talk to you about the regulatory angle. There's a lot of surprise out there. I'm sure you've seen it as well, that this was even allowed to launch. We are in a brave new world when it comes to regulation. And what do you think this says about this new SEC's willingness to let innovative products, if you want to call them that, come to market, especially when you think about what's going on with crypto right now?
Yeah, this and a couple things that happened in the altcoin filings, to me, have signaled this is going to be a much more lenient SEC. If you've read Hester Peirce's comments on several different issues, she's libertarian. She thinks, look, let innovation happen. Just disclose, 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 and let the customer decide. That's the capitalistic market we live in. Gensler was a little more like, a little bit more nannyish, to be honest. So here we're going to have, I think, a lot more products that come to market. That's going to make me have some job security because we're going to have to vet these products, explain the risks and whatnot. But overall, I think you're going to see a lot. Brave New World's a good way to put it. We talked about, we could see over 1,000 launches this year.
Wow.
We could see ETF share classes, altcoins. It's going to get pretty wild. And this one is, to me, a trailblazing ETF that it could start a whole new category of all kinds of illiquid instruments in ETFs.